Have you ever pondered over why financial transparency is crucial in businesses? It's a question that holds the key to trust and credibility in the corporate world. Financial transparency is more than just a buzzword. It's the cornerstone of a business's relationship with its stakeholders, from investors to employees and even customers. When a business is financially transparent, it sets the stage for informed decision-making. Stakeholders can accurately assess the company's health, predict its potential trajectory, and make decisions accordingly. It's like having a clear roadmap guiding you towards your destination. But there's another side to financial transparency. It's a powerful deterrent against fraudulent activities. When the books are open, there's no room for shady transactions or misleading disclosures. Just like a well-lit street discourages crime, transparency keeps businesses honest. It's an ongoing process, though. A business must continually strive for transparency, nurturing trust and confidence in its stakeholders. It's not just about doing the right thing, but also about fostering a culture that values honesty and openness. Let's delve deeper into a classic case that highlights the importance of financial transparency: the Valeant Pharmaceuticals scandal of 2015. In 2015, Valeant Pharmaceuticals, a major player in the pharmaceutical industry, shocked the financial world with its misleading financial disclosures. The financial landscape was rocked to its core when Valeant, a company once hailed for its business acumen, came under scrutiny for its deceptive financial reports. Let's break it down. Valeant was accused of overvaluing its assets and revenues, a move that not only distorted their financial health but also misled investors, analysts, and the market at large. So how exactly did they do it? Well, Valeant inflated the value of its assets, primarily its acquisitions. By reporting these inflated numbers, they painted a picture of a company in great financial standing, a company that was growing at an impressive rate. However, this was far from the truth. In reality, the company was not performing nearly as well as they wanted the world to believe. But it wasn't just the assets. Valeant also misrepresented its revenues, stating higher sales than what was actually earned. This manipulation was achieved by prematurely recognizing revenue, a practice that is not only unethical, but also against accounting principles. Now, you might be wondering, where was the management in all this? Unfortunately, they were not just silent observers. The management, the very people tasked with the responsibility of ensuring transparency and integrity, played a crucial role in this scandal. They were the architects of this financial deception, crafting a narrative of success and growth that was based on falsehoods. The result? A massive financial scandal that shook investor confidence and brought into question the integrity of the company's leadership. But this wasn't a scheme that could be kept under wraps forever. As the saying goes, the truth will out. But how did this all come to light? Enter the Securities and Exchange Commission. The Securities and Exchange Commission, or the SEC, is a watchdog for investors and financial markets. This powerful regulatory body plays a crucial role in maintaining financial transparency, and its investigative prowess was put to the test with the Valeant case. Let's delve into how the SEC uncovered Valeant's fraudulent activities. The investigation began when discrepancies were noticed in Valeant's financial statements. These inconsistencies raised red flags, prompting a closer examination. The SEC, with its mandate to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation, took immediate action. Their investigators delved into the complexities of Valeant's financial disclosures, meticulously combing through every detail. This wasn't just a cursory glance at the numbers, it was a full-fledged forensic analysis. The investigators looked beyond the surface, scrutinizing every transaction, every reported revenue, every fiscal quarter. They left no stone unturned, no line item unchecked. This wasn't an overnight task. It required a significant amount of time, expertise, and dedication. It's a testament to the SEC's commitment to maintaining financial integrity in the marketplace. The investigation was rigorous, methodical, and thorough, exemplifying the SEC's relentless pursuit of truth in the financial world. As the investigation progressed, the SEC discovered that Valeant had indeed been misleading investors with its financial disclosures. This was a significant finding, as it confirmed the suspicions that had initially sparked the investigation. With this confirmation, the SEC was able to take the necessary steps to hold Valeant accountable for its actions. This included not only identifying the fraud, but also determining the extent of the deception and its impact on investors and the market. The SEC's intervention led to significant penalties for Valeant. Let's find out more. As a result of these misleading disclosures, Valeant faced hefty penalties. The consequences for Valeant were far-reaching and severe. The company was slapped with financial penalties that ran into the millions. This was a substantial blow to a firm already battling to regain its financial footing. Yet the financial penalties were just the tip of the iceberg. Valeant also suffered significant reputational damage. This was a hard pill to swallow for a company that once prided itself as a leading player in the pharmaceutical industry. The trust that Valeant had carefully built over the years was shattered in an instant. Investors and stakeholders were left questioning the company's integrity and credibility. The aftermath of the scandal hit Valeant's stock prices hard. Investors, shaken by the revelations, pulled their support, leading to a sharp decline in Valeant's stock prices. The company that was once a darling of Wall Street saw its market value plummet dramatically. The investor trust once lost proved difficult to regain. The ripple effects of the scandal continued to be felt long after the fines were paid. Investors became wary, and the shadow of the scandal hung over Valeant, affecting its ability to attract new investments and partnerships. The Valeant scandal serves as a stern reminder of the importance of financial transparency. But how can such situations be prevented? Preventing financial statement fraud is a collective responsibility involving companies, regulatory bodies, and investors. It's a three-pronged approach that requires vigilance and a keen eye for detail. Let's break it down. Firstly, companies must establish robust internal controls. This includes checks and balances, segregation of duties, and regular independent audits. These mechanisms ensure that no single person or group has unfettered control over financial reporting, which significantly reduces the risk of fraud. Secondly, regulatory bodies must perform their oversight duties diligently. This involves setting stringent reporting standards, conducting routine inspections, and enforcing penalties for non-compliance. After all, when the rules of the game are clear and enforced, players are less likely to cheat. Lastly, investors. You're not just passive spectators, you're active participants. This is where financial analysts come in. Through careful analysis of financial statements, analysts can detect anomalies and potential red flags. For instance, sudden, unexplained increases in revenue, inconsistent cash flow patterns, or significant deviations from industry norms could all be indicators of possible fraud. In the case of Valeant, a careful scrutiny of their revenue recognition practices, intercompany transactions, and off-balance sheet activities might have raised eyebrows. In conclusion, the Valeant scandal underscores the critical role of financial transparency in maintaining trust and integrity in the business world. A world where everyone plays their part in ensuring that the numbers we see are as real as the products and services these companies provide.